And ladies and gentlemen, Zomato's board yesterday approved a resolution to change the name of the food and grocery delivery company to Eternal Limited. Now, while the name of the listed holding company will change, the Zomato brand for the food delivery business will continue. In fact, we caught up with Karan Thorani of Elara Securities on the name change and what could it mean for the company going forward.
There is no material impact in terms of the financials or the management or the way the company functions in terms of operations. But just 2-3 points to highlight here. I think this move is a very good thing because what was happening is that because Zomato was the mother brand, a lot of spotlight was coming on Zomato. And if you look at the other business segments, Blinkit rather, it actually has a very big potential market and it's actually going to become much bigger as compared to what Zomato food is. So you are not going to overshadow just one single brand, and that is something which is going to help the cause in terms of why the name is changed. It's basically an evolution of an internet conglomerate. It's happened globally as well. If you look at many of the other companies like DoorDash globally, they also have kind of multiple brands under the umbrella branding strategy, which is their AliExpress as well. So I think this is something in line with what global internet conglomerates do. Also, very interesting perspective here is that there is nothing to do for the customer. So there is no negative impact in terms of customer mindset because the app names have not been changed. So Blinkit, Zomato, all these app names will not see any kind of changes. So there's no negative impact for the customer. One more thing this is going to work out for in a very positive manner I see for Zomato is that Eternal can actually expand into new business horizons because Zomato primarily started as a food tech company. So you have Zomato, Blinkit, you have Zomato Hyperpure. A lot of confusion was there in the minds of the customer. So having Eternal as a brand and having multiple brands under that also gives you the leverage to kind of expand into new business offerings.
Well, staying with the food delivery space, Swiggy's shares stumbled over 6% yesterday for the first time after the company's losses in the December quarter widened. But what's the view that brokerages are holding on the company's growth prospects going forward? Let's take a look.
Well, Swiggy reported a Q3 number on 5th Feb and post that Swiggy is down almost 10% till today's trading session. And the company's reported a net loss at Rs 799 crore as compared to 625 crore loss quarter-on-quarter basis, and overall a weak set of number company reported. And there are also a couple of brokerages note coming on Swiggy there where Macquarie has maintained the underperform rating with target price of Rs 325. They say that the quick commerce business face serious profitability challenges and the losses in quick commerce are higher than the expected. Company's network expansion plan and the competitive intensity has impacted margin, and Macquarie prefers Zomato over Swiggy. UBS has also come out with the note on Swiggy where they state that the profit margin will remain under pressure for the next few quarters, and unlike Zomato, Swiggy has not increased its expansion plan for the dark stores. And if we talk about stock performance, then the Swiggy stock fell below its IPO price on Jan 28, and stock is down almost 40% from the December high. And there are also management commentary coming in where management state that the quick commerce is in the investment phase to turn profitable in next 6 to 7 quarters, and they expect contribution break even by Q3 FY26.
And ladies and gentlemen, before we end the show, let's take a quick look at this news coming in from Myntra. Well, the online fashion retailer has received an $80 million fund infusion from its parent firm Flipkart. This is coming in at a time when the company is pushing its quick delivery offering for apparel, and especially when competition is all set to hot up in the fashion space with a comeback of Shein. And my colleague Ishwarya Patil now getting us more details on this fund infusion.
Fast fashion and faster delivery seems to be the way to capture more skin in the game for apparel companies in India. Myntra, back in November of 2024, secured a fund infusion through its Singapore-based parent company, FK Myntra, of about $81 million. This particular funding was followed by its previous funding of $339 million back in March of 2024. And all of this comes on the back of them also launching M-Now or Myntra Now, which is a 30-minute delivery service. And the first phase of it was kicked off in various cities, including Bangalore, Mumbai, New Delhi, as well as Pune. And they will be expanding it to other pin codes as well, as what they have said. Now, as far as fast fashion is concerned, the most latest entrant in this space has been Reliance Retail, who has unleashed the Chinese fast fashion brand Shein into the country. So competition is definitely heating up in that particular space. As far as Flipkart is concerned, they have upped the ante in quick delivery as well with mNow and Flipkart's 10-minute delivery service as well. Now, competition is going to get narrower as more and more of these brands focus on quick delivery. Myntra competes with the likes of Reliance Retail's Ajio, Tata Click, Nykaa Fashion, and so on and so forth, apart from the already existing e-commerce or online fashion space. Quick commerce players like Blinkit, Zepto, Swiggy, Instamart are also now offering 10-minute delivery of apparels through their platforms as well. And Myntra, like I mentioned earlier, has launched mNow, which is a 30-minute delivery service. So definitely competition is heating up as far as fast fashion is concerned. Also, faster delivery is increasingly becoming a focus for all of the e-commerce companies as well.
Well, thanks very much, Aishwarya, for bringing all of those details and putting that development into context with respect to industry developments. And ladies and gentlemen, it's time's up from us right here on Startup Central. Hope you like the show as much as we did putting it together for you. You can write to us at suc@etnow.tv for anything that you'd like to watch on the show. And if you have any feedback on the show, goodbye and thanks very much for staying with us.